love the channel and find it useful in becoming a happy retiree. Subscribe today. We have gone through a year, 2018, that is full of emotion and peaks and valleys in markets, not to mention politically. And we're going to talk about that. I know that there are worries when it comes to, does diversification work? Do bonds still work? We had a lot of great calls last week that really helped me understand what you are worried about as investors. So I wanted to talk about that today. We wrote about that this week, and it is the topic of conversation. Are bonds safe? Do they still hedge against stock market drops? We'll also recover or talk a little bit more about this all-important rule. We had so much feedback from last week's show about folks saying thank you for covering the topic that it's not talked about a ton because it's not the most exciting piece of information, but it's arguably the most important when it comes to investing, and that is how much can you take from your portfolio? What's on average every year? What are you allowed to withdraw without so that you're not worried about running out of money completely? And if you think about one of the primary fears we have in life is running out of money. So as you can imagine, a withdrawal rate, once you stop making money and you get into retirement, you've saved all these years, how much can you take? I've talked about the $1,000 a month rule for many years now. The $1,000 a month rule is based on, based on the round numbers of let's call it $250,000, actually $240,000 to be exact. $240,000 times 5% in a given year equals $12,000 exactly. Divide that by 12 months, it's $1,000 a month. It's meant to give you an idea or a guide of when you're saving money, how you're saving money, what are the benchmarks, and what does it mean to get to a certain level or a benchmark or a hurdle. And I think it's important for all of us to remember as we are slugging away day after day, week after week, month after month, saving money. Well, what are we doing it for? And what is it going to produce for me in 20 and 30 and 40 years from now? And the $1,000 a month rule is designed for you to have a benchmark in your head. Say, okay, for every about $250,000, that's going to mean my own personal pension of $1,000 a month on average over time. And it's important to understand that a rule of thumb is a rule of thumb. It's not an exact measure. It's not something that it's meant to be as a guide. So the thought of the $1,000 a month rule then dovetailed with the 4% rule, which is kind of the original study by a man named William Bengen, who had a degree from MIT, very smart guy, did a study back in the early 90s and said, hey, if I had retired at any given year, 1927, 1928, 1942, 1957, and I took out 4% of my money every single year, or 4% year one, and then I ratcheted that same amount up by inflation every single year, and I was invested half in stocks, half in bonds, how long would it last? And it became a very important study because it showed us that if you stayed invested and you rebalanced every year, for the most part, 80% of the time, 80% of cases, money did not run out for 50 years or more. There were a few instances, 20% of the time, where money did run out if you had ultimately the worst possible timing. So let's say you retired right as the Great Depression started, and you suffered that kind of downdraft in markets right away, or you retired in 1937 and the market dropped from 37, 38, 39. There was a period of time down 33%. Or if you retired in 1973, where markets went down 73, 74, not good years for markets, stocks went down 37%. What did those periods of time mean for you personally, or an investor that would have retired at that period of time? Did they run out of money or not? And the answer is there's a couple of instances where money did run out. In these cases, they ran out after about 35, 36 years. That study is important because it gives us a guide to say, okay, well, if I take 4% of my money year one, and then I take that same amount plus inflation every year for the rest of my retirement career, what are my chances of running out of money in 35 years? Well, if you look at Bengen's study, you have a pretty good shot of not running out for at least 35 years or more in most cases. What we did at my firm the last couple of weeks is try to bring that study up to date. I wanted to see what that same methodology looked like if you retired in 2000, right before the crash of 2000, 2001, 2002. What about retiring in 2007, right before we entered the Great Recession? What did that look like? So I want to revisit those numbers and talk and focus more. We didn't get a chance last week to focus in on probably arguably another important or critical piece of that, and that's dealing with inflation. So we didn't get time last week to talk about the impact of inflation because it's a very big part of the conversation. So we're going to talk about that today. We're going to talk about this relationship between stocks and bonds as an investor. Many calls came in, so we'll start there. Many calls came in last week that said, wait a minute, Wes, I'm worried about my portfolio because when the market corrected down over 10% in the S&P 500, you may have logged in and looked at your account that day. And whether you have an account at Fidelity or Vanguard or Schwab, we live in a real-time, real-access world where the value of our 401k, the value of our portfolio is just a tap away, whether it's on our desktop or on your iPhone or your smartphone. You log in, and in 2 seconds you say, oh, my retirement is up 1,000 or up 10,000 or down 1,000 or down 10,000. So we live and breathe. It's almost unavoidable to see what's happening in the world around us as investors. And you probably logged in during the crisis, not crisis, but the last correction that we had, and you notice your portfolio was the stock side was down, and hey, I own bonds, Wes, for protection or safety, but the bond side was down. So you look at this sea of red, and you said to yourself, wait a minute, I thought that this side of my portfolio or my 401k, it's invested in bonds, and it's not supposed to go down when the stock market does. And that relationship didn't work. And it brings up a very important question. Does the diversification of fixed income or bonds, does it still protect you? Does it still work? So for years, you've heard that, listen, hey, diversification, that's the key, or really asset allocation, which involves a mix of owning stocks that are, let's call that the risky side of the equation, and bonds, which are the conservative side of the equation. And the story goes something like this. When stocks correct and they go down, let's call it 10% or 20% or 30% or more, very much like the two corrections we've had in the last decade and a half. I'm sure you remember the 2000s when we were down 3 years in a row. Market was down about 50% at one point during the Great Recession in 2000 that started in the beginning of 2007 or the end of 2007, 8, and 2009. There was a point where the S&P 500 was down 56%, 6%, yes. So when stocks correct, bonds, on the other hand, should move in the opposite direction, or at least on those scary days or those scary weeks or months, that's where you're expecting to get some sort of buffer against stock drops and stock volatility. So during the Great Financial Crisis, S&P 500 for the year, the full calendar year of 2008 was down 36%. There was a period of time where it was even worse than that. And the slide continued into 2009 before markets turned around. But if you look at what happened during that calendar year, so we're looking at 2008, stocks were abysmal. But if you owned 3-month government bonds, so really short-term government bonds, meant for safety, not getting a whole lot of yield out of a 3-month government bond, you had a rate of return, though, that given year of 1.59%. The 10-year Treasury bond, the full rate of return that you got through 2008, a whopping 20%. You had a 20% positive return during 2008 versus 36% drop for stocks. 2000 through 2002, similar, S&P 500 dropped 3 consecutive years, down 9%, down 12%, down 22%, 3 years in a row. The return on the 10-year Treasury bond during those same 3 years, up 16.5%, up 5.5%, up 15% respectively. So essentially, stocks went down, bonds went up. The strategy worked, and it has continued to work that way for most of the corrections on the stock side that we've lived through. So I want to talk about that relationship because there was a little bit of a breakdown in that relationship in the most recent market pullback. I want to explain to you what happened, and then we're going to talk about that relationship moving forward. Do bonds still make sense? Do they still protect you? Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.